Hi, this is Jeff Barton for the Mortgage Minute, and welcome to the show. We're on LinkedIn and we're on Facebook as well as Instagram and a number of other social media outlets. The number behind me, the NMLS number, and the company name Malibu Funding sponsors the show. I work for them, and thanks very much for listening. Let's get right to it. Interest rates. Interest rates have gone up, and they continue to go up, albeit creeping. A little up, a little back, a little further up, a little further back. It's a back and forth situation that eventually ends, as 3 months ago will show us, a half a point higher in about 3.5, 4 months. 30-year fixed rate loan is at 3.25%. The 15 is at 2.60. The FHA is at 2.90, 3.15 for the jumbo. That jumbo really stays pretty solidly where it is and has for the last 6-7 months. 3.48 for the 5/1 ARM, and that 3.48 number interest rate really represents a huge jump. This particular 5/1 ARM was down at 2.75 not all that long ago, maybe 6 weeks, 8 weeks ago. So to watch that and why it does that is very interesting. The 10-year yield is at 1.46. Again, we for the last 2 or 3 weeks have been hovering between 1.45 and all the way up to 1.7, and we will probably continue to do that as volatility in the mortgage market really reflects what's going on internationally, whether it's in China with a huge investment and real estate companies, whether they're solvent or insolvent, and it affects a large part of the Chinese market, 25%, or whether it's here in the U.S. and Omicron and what's happening with that, how it's going to affect markets, whether people are going to get sick, whether they're not going to get sick. From what I can understand, this is a weaker virus, so we probably won't see the urgency in the hospitals or on the medical, world in order to fix that problem by extending itself more and more. So it looks as if both of those things are going to be in check at least through the holidays. I think what we have is inflationary issues, and the Fed has stepped in and said, look, we made a mistake. This is Jerome Powell saying it. We made a mistake. Inflation is worse than we thought, and we're going to do something about it right now, i.e. the taper. Taper is ending sooner than later, probably in March or April rather than June or July. Whether that's a good thing and whether that'll curb inflation. It has traditionally, but these are not the same times as they were back in the 70s when inflation was running at 18%. Also, the slowing economy in China, how that's going to affect us. I think that's going to affect us a lot more than the virus because China is, whether you like it or not, the biggest influencer of what's going to happen in the U.S. They buy a lot of U.S. products, they trade in U.S. dollars, and they make all the U.S. products. I mean, this is inherent to whatever is going to happen here is happening there. So whether it's supply chain, whether it's funding of the economy, and China has just said that they're going to loosen rather than tighten, as we're doing here in the U.S., some of the financial constraints on the economy. Either they're going to do a QE type situation there, or they're going to make credit more available, or they're going to lessen the requirements on big banks to hold money in capital. One of those three things will happen, which is just the opposite of what's happening here. Yes, inflation is happening in China. I think they for whatever reason, don't want to see their economy slow to be below 4.5%, which it was in November. So stay tuned on that. Let's see. Yeah, we're going to raise the rates, right? Everybody knows that. And not the mortgage interest rates. These are the short-term interest rates borrowing through the Fed discount window that most of the major banks do, either on an overnight basis or on a short-term basis. And that's a big deal because less liquidity in the market is not a good thing for lending in any respect. It will affect the mortgage interest rates as well. $2.6 trillion in mortgage-backed securities held by the Fed. That's a big number, right? Some of the monies that they spend on these mortgage-backed securities aren't necessarily having anything to do with the taper or the quantitative easing. It has to do with what happens when a mortgage-backed security is sold to the secondary market. People pay off their mortgages, people refi their mortgages, and they become holes within these mortgage-backed securities. And they are guaranteed, I think it's 7 years, but I think there are different year terms when it comes to mortgage-backed securities. So what happens? Well, the Fed has been purchasing loans and pools of loans in order to fill those particular holes within the tranches or within the mortgage-backed securities that are being used and being bought and sold on the secondary market. That's another thing to keep an eye on, whether that's going to continue or whether we're going to continue to see, the the Fed actually do that. Anyway, I'm Jeff Barton. It's 5 minutes into the Mortgage Minute. Appreciate you listening. I'll see you tomorrow.